Hello everyone and welcome back to Southern Wealth. I hope you guys are doing very well. If you do enjoy the content, please consider dropping that like and subscribe. As you guys know, it's the only thing that I ask. So, bonds have been recovering quite well. Is it this time that we can actually crack the 90 on TLT and stay above it? It seems that we're trying to build up momentum to go and retest the 200-day on the TLT again. We failed quite a few times. Let's see if this is the time that we're gonna see it. Then, as you guys know, I've been talking about this almost in every single video. Everybody was concerned about tariffs. Everybody was concerned about bonds and yields. And I said, to me, what concerns me the most is things like Iran and Taiwan. And now everyone's talking about Iran. Yeah, once again, we talk about these things in the channel weeks in advance. Everybody's paying attention to the wrong things, and then weeks later, everybody comes and pays attention to the right things. I hope that situation can be solved peacefully. If you ask me from a pure investment perspective, I think we're in. If that escalates, we're in for some short time period of quite the volatility. I think at the end of the day, we end up in the same solution, which is issue more debt, have more deficits, print more money, more liquidity, risk assets go up. Maybe not in the next 2 weeks, but over time, that's the direction of the market. But it's important to pay attention to the situation because it involves humanitarian problems. It involves, if it escalates into that, we all know how these conflicts are resolved, and usually is with a lot of young people, not making it. So in that sense, to me, it's more complicated than when everybody's looking at something. The dollar is weaker. This is important for risk assets. By the way, I'm already seeing this notion by Peter Schiff, so I have to come here and correct it. So the idea is, with the dollar being weaker, and because the US imports so much, costs go up and inflation goes up. We always end with the same story. We just had better than expected CPI and PPI again. It starts to become a little bit repetitive. Remember all those experts predicting massive inflation? And we came here in the channel and said, relax. There's a lot of moving parts. You're talking about too many things at once. So be careful to make all those kind of predictions, because you are in a very good position to get completely blindsided. So be careful what you say. So that was the point here of the video, the videos that we've been making. So the notion is, if the dollar index keeps going down, inflation's gonna skyrocket, right? Really? 2010 to 2020, average inflation 2% per year. Average Dixie throughout the same time period, 88. It's currently 97. And what happened in the years where the Dixie was 77, 82, 81, 83? Oh, we had 1.4% inflation, 1.2% inflation. Again, these things, so basically the complete opposite. The reason I'm telling you is because you're going to see this narrative coming quickly. You're going to see this narrative that with the dollar weakening, inflation's going to go ballistic. That's the next narrative of collapse and crashes that is about to come. I'm just telling you a few weeks ahead of time. Now you know, because you will never be provided context. Because the question would be, will the weaker dollar immediately result in higher inflation? That's the question. And the assertion that's going to be made is, yes, weaker dollar means higher import costs, means higher inflation. Then this is the narrative. Then the reality. Average inflation 2%, with the Dixie as an average of 88. And the years with lower inflation corresponded with years with the lowest dollar as well. Oh, hang on a minute, that's the opposite of the narrative. Yes, but the facts will never be presented to you. So not only am I already telling you the next narrative, I'm already telling you the facts of why that narrative is a lie. Basically, that's what I'm doing. Stocks remain quite resilient, but losing some momentum. It's normal. We've done nothing but go up, virtually uninterrupted. Eventually, we need to have some pullbacks, some breathers, some slowing downs, some non-explosions in the price of assets. What a crazy idea. Liquidity keeps on going up. As you guys know, sooner or later, that's what matters. The reality is, as long as stocks and crypto and other assets are denominated in dollar, euro, yuan, yen, rupee, whatever you want to pick, as long as that happens, and as long as governments and central banks take out the value of those currencies, then asset prices will keep going up. Should the Fed be cutting? Yes, the Fed should be cutting for quite a long time already, but unfortunately, the Fed is extremely political. So expect this kind of non-action until May of 2026. I'm not saying that they're not going to cut until May 2026. I'm saying expect slower, later, less action than they should perform. That's it. Unfortunately, the only time that Powell showed any haste in cutting rates was in September and October to try to make sure that his pal Kamala would be elected. Didn't work. So we continue the grind up. We continue to progress. Liquidity rules the game. It's hitting new all-time highs. China just had one of the worst months in terms of deflation, particularly for corporates, so that deflationary pressures continue. I would be keen to start seeing some more concrete trade deals, potentially next week, maybe even this one, we'll see. More importantly is that we solve the situation in the Middle East. And with that, I'll keep it short and brief and nice to the point today. Don't forget, like and subscribe, it greatly helps the channel, and I'll catch you in the next one. See you guys.